All right, I hope everyone is doing well. This is going to be a video more over mathematics and probabilities with trading more than actual charts. And the reason for that is it's important. And I think it's something that people highly overlook when they're studying now. They're looking for how to read charts better, but they can easily miss one of the biggest concepts, and that's mathematics of trading, probabilities, risk reward. You all know there's three variables: probability and risk reward. You're never certain exactly what the probability is. However, you know the risk and the reward because you can obviously set those, as Al says. And what I want to start with is the foundation of just directional probability. So what's the probability that if I risk, now I'm going to equate this to dollars. This is obviously the E-mini. A lot of people watch that market that are listening to this video, but I want to talk about more in dollars because it's easier to compute and comprehend. And I'll show an Excel sheet in just a minute, but this is going to be really more or less what's the probability of risking $50 to make $50. And really what I want to go into is and let me try to transition here. What I really want to go into is what Al talks about Al's 40 to 60 rule. And what that exactly means. And the 40 to 60 rule, it's not necessarily a rule, but it's generality. 90% of the time the market's has a directional probability of 40 to 60%. So at any given point, if you buy above a bar or sell below a bar and put a stop in a reasonable place, worst case, you're going to be right 40% of the time. Best case, you're going to be right 60% of the time. And depending on the trade management, other variables change. And that's for the majority of the bars. Al says 90%, sometimes he says 95%. And really what he's just getting at is that most of the time it's between 40 to 60%. Now, you can break the 40 to 60% rule down to three categories. 60%, I'll put over here, is certain, or confident, if you want a different word. And 40% is uncertain. Probably a better way to put that is confident and not confident. And 50-50 is obviously 50-50. Flip a coin. So let's just put maybe coin flip. So why do I break it down like this? And that's to keep it simple. Al does the same thing. And if you listen to some of his videos, you'll talk about it. You'll hear him talk about this. But you can put the market generally in one of these baskets when you're picking a trade. And if that's the case, the most important piece is and this is up here, how you manage the risk and the reward. So I've got three examples above. One is a probability where, one is you're risking $50 to make $50, and your risk reward is 60%. So your risk reward is 1. You're risking 50 to make 50. So risk 50, reward 50. Your probability of success is 60. So, and that's out of 10 trades. So if you took that trade 10 times, you'll make $10 per trade on average, and you'll make $100. Now, obviously there's other variables. There's commission, there's slippage, there's bid-ask spread, and human error. But I just want to keep all variables constant. The next one is a situation where your probability of success is 40, but your risk is $50 and your reward is $100. So you're going for a 2-to-1 risk reward. So here's 2-to-1 risk reward. Here's 1-to-1 risk reward. So 1-to-1 risk reward, 50-50, 60% probability of success. 2-to-1 risk reward. I don't like how it did that in Excel, but oh well. 2-to-1 risk reward. you're risking $50 to make $100 on a 40% bet. The next trade is you're risking $100 to make $50, and your probability of success is 73.5. Now, the key thing you should notice about these three setups is this right here. It's around the same average per trade. Now, another way to look at that is every one of these examples is actually fairly marginal math. It's okay math. It's not great though. It's very it's average, or as Al puts it, it's kind of like getting a C in a class. It's enough to pass the class, but it doesn't put you in the top 10%. So the reason I'm bringing this up is it's basically it's three examples, and you can alter them based on trade management or trade selection. So let's start with, let's look at what the most difficult out of these three, which is the most difficult, and that's going to be this bottom one right here. If you look at it, your probability of success is 73.5%. Now, how can your success be 73.5% if I just mentioned a minute ago that 40%, you can either be 40 to 60%, and 73 is 13 percentage points outside of Al's boundary, the 60-40 rule. Well, if you're really good at selecting trades and you're scaling in and a couple other factors, then you could probably achieve that. But this really is the minimum that you have to achieve in order to risk twice your reward. And that's a very difficult strategy, and that is why Al recommends you should always go for at least 1 times your risk. And that is because when you really break the math down, it's marginal. You could probably make a lot more doing something else. The next portion is 1-to-1 risk reward. That's the second most difficult. And you have to be 60% in order to basically break even. So if you really think through that, well, most of the time the market's between 40 and 60. So this is at the far extreme of 60%. And any slight deviation in the probability, that can, if you're risking $50 to make $50, you may have a 60% chance, but that can quickly change. So the whole point with this is going to be your easiest. This will be right here is going to be the easiest, number 2, to manipulate. Because 40%, if I go for 2-to-1 with a 40% probability of success, if I can get a little bit better at trade management or take higher probability trade setups, maybe I can increase this to 45%. And you can see it goes up 17.5, or maybe I can get to 50%. And that increases to 25. So this is where a lot of people kind of get mixed up, is they listen to Al, they know Al does a lot of this category, scalping, risking, going for less than his risk, and they say, well, gee, if I can just get better at trade selection, and then I can achieve a higher probability and I can scalp. Well, that's true, but that's also very difficult. And I want to, before we start changing up a lot of these numbers, I want to kind of go over a few pieces. So for the E-mini, let's say the average commission is $5. Well, if that's the case, let's take the first trade. If I've got to pay $5 round trade on one E-mini contract, then if I'm risking 1 point to make 1 point, then really my reward is $45 and my risk is $55. So now look, my per trade just went down to $5. So it would take me 10 trades. If I lost 1 time, it would take me 10 average trades to make up for that loss. Let's do this one down here. Let's say my reward is $45. And now my risk is $105. Takes me down to $5 per trade, 5.25 if you want to be real technical. What about this one? Well, my reward is $95 and my risk is $55, takes me down to $5 per trade. So again, where I'm getting at is these three categories are very marginal. If you're basically averaging in the E-mini less than one tick per profit, and that's not good math because it's so easy to lose, and any slight error is going to wipe out your losses. That's why you hear, and I'm sure everyone's done it, where you take 10 scalps in a row or 8 scalps in a row and you do really, really well. And I want to kind of transition to a chart real quick for an illustration. But let's say you are, I know there's some examples over here. Just one moment real quick. I can't see mine. Fortunately, I can't see my cursor. Yeah, so let's say you sell this close, you buy this low, scale in, you sell it here, scale in higher, scalp out, and then you buy this low and you scale in, you scalp out and make money. And then, so you made 4 or 5 profits in a row, and then all of a sudden and let's say you're risking $100 to make $50, and ignore the price scaling on this. This is just an example. And then you buy this low, and all of a sudden you become paralyzed and you can't get out. Well, it's very easy to get trapped and take such a huge loss that you're going to wipe out all the wins you made over here. That's why it's, in general, better to go for twice your risk and take a swing trade. So let's go back to this. So, and I know this isn't the most fun discussion to really have, but I think it's one of the most important things someone can realize, and that's just understanding mathematics and directional probability, because it's really the foundation to the way computer algorithms think. I mean, it's to the way computer algorithms are programmed. And everything's rational. Nothing is random. It's all probability, it's all risk reward. So it's super important to understand it. But what I want to really focus on is eliminating, most people need to eliminate this. I get the logic. You can say, well, okay, if $5 is commission, then I'll go for $55 and I'll risk $50. And that's good. You'd be going for a little bit more than your risk. That's great. But it's still really difficult. So what I would focus on is this bottom one down here. I'd go for at least twice your risk. So if you're risking $55, go for $110. That's what I would truly focus on. And if you can select reasonable trades and get good at trade management, you might be able to get to 50% probability, which gets you to here. And if you could do that consistently, you've got a much better shot at being profitable than other scenarios. Now, again, this is just mathematics. You still have to be good at trade selection. You still have to be good at management. There's all sorts of other factors, but this is one everyone gets glued to looking at, especially when you're studying out, they get glued to looking at charts and understanding how to read charts. And the more confident they get at reading charts, the less they start focusing on the math. So the first thing I would start with is, how do I start structuring trades where I have a reasonable chance of getting 2 times my actual risk? And if you don't know what actual risk is, look it up in one of Al's books or videos. He talks about it plenty of times, but it's pretty much what you actually had to risk on a trade. So what I want to talk about going forward is really this category right here. And that is trades where I've got a reasonable shot, 50-50, even if it's 45%, where I've got a reasonable chance of making at least twice my risk. And I want to say one more thing about 40%. You may take a 40% trade and risk, $50, and maybe you hold for a swing and you're able to make 2 or 3 times your risk. What if you can make $150? Well, look at that. If you can make 3 times your risk, that's $30 per trade instead of up here where you're risking $50 to lose to make $50, or you're risking $100 to make $50. So this is the key for most people to get profitable. And again, this is just mathematics. This is not, just because you understand this concept doesn't mean you still have to understand how to manage trades and how to read probability. You can't just, blindly say that if I just take 10 trades in a row and go for twice my risk, I'll be profitable. That's not what I'm suggesting. But what I am suggesting is understanding probabilities and how to structure trades. Trade management is much more important than trade selection 90% of the time, because 90% of the time the market has a 40 to 60% probability. Okay, and now I want to transition to the chart and give some illustrations. So we'll just use the most recent day. If I can get to it. There it is. So where I'm getting at is trying to structure trades where you've got a reasonable chance at making twice your risk. And, to be clear, a lot of people will, they'll finesse what I'm talking about. So what I mean is they may, let's think of an example here. They'll take this low, and when the market's over here, they'll look at this bar and they'll say, yeah, it's a trading range. We'll probably fail to break out below these lows. So what I'll do is, I'm confident that I can get twice my risk. So I'll buy this close or buy the low of this bar, and I'll risk a measured move down. So something crazy like 30, 40 points lower. And I'm confident that I'll be able to make twice my risk. Now, realistically, what I think they would do is they're going to, before I go further, they would buy and they'd be willing to scale in, but their stop would be somewhere down here. But what they'll do is they'll look at this and they'll say, okay, looks like price is starting to bottom, it's turning up, so what did I have to risk on this trade? Well, I bought the low of, let's just say, this bar, and if the market turns up here, my actual risk was this low, so 1 times my risk is here. Well, that is mathematically okay to take profits. And other traders will say, yeah, it's still always in long. I'll go for twice my risk. This blue line. So I'll go for up here, twice my actual risk. And not quite there. Now I got there. So if a trader was to buy this low, actual risk was here, price rallies, then maybe they move their stop down here. And then they get out here. That's just an example. It's really not that simple, because I think the reality is most traders would buy, scale in, and then they would scale in. When price rallies, they'd get twice their actual risk and just get out. But let's keep this more simple than that. That's just kind of an example of wide stops. What most people should focus on is stop entries. So if you sell below this bar, put your stop up here. Should you go for 1 times your risk or 2 times your risk? Well, what's the probability of making 1 times my risk? If I sell here, so I sell below this bar, 1 times my risk is here, there's probably a 60% chance that that's not going to happen. So if that's the case, I don't think there's a 6% chance we're going to go down here. I'm probably better off doing the opposite. So I think I've got around a 60% chance of price going all the way up to here before it falls down to here. So same example, one could buy and they'd make, twice their risk. But again, I don't want to focus on that. So most traders would be better off not selling here. They look at this, second entry buy, failed breakout of yesterday's lows, failed breakout down here. If they buy above it, put their stop below here, they've probably got at least a 40% chance of a swing, and it might be closer to 50-50. So a lot of traders will buy above here, stop down here, and go for twice the risk. And even if I bought here, put a stop down here, and one put a target at the open of the day, their risk is do the math. There's 1, there's 2, so they're getting at least twice their risk. And if we did that, there's open the day, it'd be filled. There's a few other things to notice. What was the actual risk on the trade? Well, the actual risk was 1 stop, 1 tick below this bar. And so the reality is you're making many, many times your risk. Now, let's go back to the Excel sheet. Remember, this is the key for most people right here. So if they can be 50% profitable or even 45% profitable, then they're going to have a lot better chance of being consistent, going for at least twice their risk, risking $50 to make $100, or risking 1 to make 2, same example. That's going to be a lot easier for most people. Now, again, I could talk a lot about this, and I don't want to ramble forever, but it's an important concept. If it's sell to close and you sell and you put your stop up here, there's probably a 60% chance we're going lower. And you could, in theory, put a stop up here, sell this close, and keep going, and maybe you tighten your stop. And maybe you get out below here. Maybe you say first up should fail. I'll keep a stop up here. And you look to get out somewhere down here. That's okay. Most important is try and get, at least in these kind of scenarios when it's always in short, try to get 1 times your actual risk. But I mean, really, overall, what I would really harp on is if you're not thinking about the math and you're looking at the market but you're not thinking about math, directional probabilities, the probability that price is going to probability that the market is going to from here, what's the probability price is going to go all the way down here before it gets all the way up here? That is really the foundations of trading. And I know people don't like to look at it that way, but it is. You're not going to place a trade if you think that you've got a really, really bad trade. I mean, if you knew, why would you ever risk $100 to make $1 if you were certain you were going to lose? You wouldn't do it. So on the contrary, in any given moment, there has to be a reasonable reason that you're wrong. That is because there has to be someone else to take the other side of your trade. So if somebody was to, I don't know, I'm thinking of an example. Someone will buy here, buy above this bull bar and say, it's a double bottom, tight channel, but we may rally, who knows. Maybe I'll catch the low of the day and we'll test up to this high, so I'll buy above it, stop below. And another trader will say, tight bear channel, first up's minor, I'm going to sell here, scale in higher, stop up here, and I'll probably make money. And, that trader, they'll probably sell, scale in higher, somewhere up here, and they'll get out of break even. And that bull will buy, tight stop, maybe second entry sell, maybe they hold below it, and maybe they just get disappointed and get out here. So there's many ways someone may buy this low, scale in multiple times lower, get out break even. Another trader will sell, use a stop up here, and get out above the bull bar. Trade management's most important. And the last piece I'll talk about is assessing the probability of the other side of your trade. That is also just as important as assessing the probability of the trade you're in. So I've got 2 examples from this week. Let's use this one right here. Sell the close, stop up here. It's okay to do that. It's probably not, is it 60% chance we're going lower? I don't know, maybe closer to 50-50, which is why it's reasonable to swing trade. I wouldn't be so confident about selling the close, stop up here and going for a measured move down. And traders will sell and use a wide stop, but they're also going to keep track of their actual risk. So they'll sell and they'll look and they'll say, Some will look and say, they'll sell this close and they'll say, my actual risk was up here. I'll go for twice my risk. and it's the low of this bar. Hard to see it, but it's pretty accurate. Let me see if I can do this a better way. One moment. So yeah, so you'll see right here. Let me try to blow this up a little. So what traders will do is they will sell the close right here, which is 304.25, and they're going to put a stop. I'll use a calculator just to make sure I'm right. So the close is 304.25, and they're going to put a stop. They'll use a wide stop up here, but their actual risk was the high of their entry bar, which is 311.25. Now, they had to risk 7.25 points to stay in the trade. So if their entry price is 304.25 minus 7.25, 297 is exactly where... Sorry, I had to pause to think through what I was trying to say. 289.75 is twice their actual risk. So let me just make that simple. Traders will sell this close, use a wide stop, and as this bar starts to go down, they realize their actual risk was $7.25. They could scalp out for 1 times their actual risk. Other traders will use 2 times their actual risk, which basically takes you down here in price bounce. Now, that's a lot to compute in a matter of a minute, basically. So what I would just you have to think through is if you're short, your stop's up here, and by the way, it's tricky to talk this way about math because it's easy to think about it. Yeah, I think about this stuff all day, every day. So it's really, really simple for me to think about it in my head, but it's a lot easier for me to describe the price action more so than to describe the math, because math gets very subjective because it's about you can manipulate the math depending on how you manage the trade. Hence scaling in, scaling out. You can buy here, put a stop down here, take 1 contract off and measure move up, take 2 contracts and measure move up. You could scale out repeatedly and that changes the math. But where I'm getting at is there's directional probability. So let me back up for a second. I sell this low, stop up here. And if I swing trade it at this close, my stop's now from here, it's somewhere up here. So now my risk is from this close to, if I can get this to work, this close to up here, measure move down. That's 1 times your risk. So the probability is always changing. If I sell here, stop up here, I've probably got at least a 40% chance of getting twice my risk. So traders will sell. Sorry, this is starting to bother me a little bit. It's a little frustrating. Traders will sell, and nothing's working for me right now. They will sell this close, stop up here, and there's 1 times the risk. Traders may go for 2 times the risk down here. Once the market closes down here, it's probably greater than 50-50 that they're going to go at least a little bit lower. Then you get down here, the directional probability is increasing for the bears, but the risk reward is getting worse and worse. So what does that mean? Well, my stop's up here, and now price is down here. I'm risking a lot to maybe this target, and the probability may not exactly be 50-50. So I can't risk this much unless I think the probability truly is 60% that we're going lower. So what that means is when price starts to go sideways and pause and get this, I'm in a little bit of I've got to think through this, because do I really, and let me back up with one more piece. This is why people get frustrated at Al for being all over the place, and the reality is there's so much to interpret and talk about. You can't just do it in one video and make it really simple. So you're gonna have to bear with me with these kind of discussions. They're not that simple to bring out. However, at this point, the math changes. What's the probability that at the close of this bull bar, price is going, if I put a stop down here, I'll get twice my risk? Well, it's probably at least 40%. So that means if it's at least 40%, then there's at least a 40% chance that if I'm short at the high of this bar stop up here, I'm wrong, which therefore that means I can't risk this much to make this much because I've got less than a 60% chance of being wrong. So I've got to figure out a way to tighten my stop. You can tighten your stop either by putting your stop, for one, you can get out of the trade. That tightens your stop because you're out of the trade. You don't have a stop in. Or you can get out at the high of this bar. So maybe I sell this close, and my risk is now from the high of this bar to the close up here, and I go for twice my risk. I could do that, but that math's probably not great either because there's probably a pretty high probability that I will get stopped out. The next thing I could do is put a stop one tick above this bar, and I get stopped out of the trade. And it's also important that there's no such thing as other people's money. If I sell this close, sell below here, and I hold short, it's the same thing as selling down here and staying short. I know people hate that and people will argue that to no end, but that's just the way I see it. I think that's kind of reality. There's another example during the Fed report of this. I just saw it. Here it is. So if you're short and you get this, a lot of bulls may put their stop, a lot of bears may put their stop one tick above this bar, betting that we could fail. Maybe it's a wedge bottom. It's still probably going a little bit lower, but a lot of bull bars. This could be a II, possible final flag. So some bulls may buy above this bar, and some bears will certainly get exit shorts above this bar. So look what happened. It didn't trigger, and it immediately sold off. So I hope this video helps. If there's, again, this is probably the most exciting thing to listen to, but it's math. And it's really, really important to make sure incorporating that into the way you view the market.